Good evening, everyone. Thank you for joining us here for the first quarter On the Move webinar with my co-host, Adrian Day. He doesn't need an introduction, but I'm going to give him one anyway. Adrian Day is a good friend for many years. He's started off after his maturation from the London School of Economics, where he graduated with honors. He wrote investment newsletters for quite some time, and eventually drifted into the realm of managed accounts. He's been a global and resource investor for many years, done well by a lot of people, I would say. I don't know, you have to ask them yourself, but we like what he does for us. And he's written books. He's appeared on every major talk show and radio show you can think of, and with good reason. Once you hear him speak, you understand why. Adrian, always a pleasure to be with you. Now, tonight, we have a wonderful guest. I'm going to let you introduce him, but he also doesn't need an introduction. Rick Rule has been an incredible natural resource investor for many years. He is. I'm here with two titans of natural resource investing here this evening, so really looking forward to this evening. But we're gonna touch, obviously, here at the turn of the year. We're going to talk a little bit about last year. We're going to talk a little bit about this coming year, but we're also going to concentrate pretty heavily on energy, and one part of energy that I know is near and dear to Rick's heart, and that's uranium. But Adrian, I'll hand it off to you.
Well, thank you, Rich. And I think you've sort of already done the introduction, but yeah, I've known Rich Checkan. You said many years, but I think many decades would be more appropriate at this point.
Quarter century,
yeah.
Just leave it there. So
yeah. Rich is the president and COO of the firm Asset Strategies International, which deals in physical metals. It's founded by his uncle, Michael Checkan, and I have known Michael. I think you have Rick as well. I've known Michael for, I don't know, since the early 1980s, so a long time. So Rich is a co-host and the master of ceremonies for tonight. And our special guest tonight is Rick. As Rich mentioned, Rick Rule doesn't really need much introduction. His career path has taken him from being a bouncer at a bar in British Columbia to where he is today. He founded his own firm, a brokerage firm. It was acquired by Sprott. Rick, by the way, I think I can say this, is still a board member and the largest shareholder of Sprott Inc. But he's now independent of Sprott with his firm Sprott Media. Puts on just an excellent resource conference every year, this year in Boca Raton. I'm sure we'll hear more about that. So we've had the introductions. Let's just start, and I'll kick it off, if I may. I know you want to talk a lot. Well, I know your career started with oil and gas, but your investment career started with oil and gas. I want to start, if I may, with a fairly specific question on oil and gas, and that is about the lack of sustaining capital investment, along with the declining institutional interest or capacity, if you like. How will that affect oil and gas production, oil and gas prices?
That's a very prescient question. One might laughingly call it the $365 billion question, because the International Energy Agency suggests that deferred sustaining capital today is running at about $1 billion a day in the oil and gas E&P sector, which is to say that the industry is underinvesting about $1 billion a day in sustaining capital. The same sustaining capital is necessary to maintain today's production. Adrian, you've been around these markets for 40 years. These are capital-intensive businesses. If you don't maintain sustaining capital investments, you don't just hurt production 2 years out. You hurt production 10 years out and 15 years out. If you look, as an example, at the track record of PDVSA, the national oil company of Venezuela, they decimated production in what was the world's third largest export country. Similarly, Mexico, by diverting sustaining capital investments from Pemex, ironically to support politically expedient domestic spending programs like subsidizing gasoline, has brought Mexico down to the point where it's almost a net energy importer. This is going on around the world. At the same time it's going on around the world, the very big thinkers, the legislature as an example, our friends at the World Economic Forum, places like that, are trying to convince the largest institutional investors in the world to restrain or eliminate their energy investments. In a capital intensive business, if you reduce capital expenditure, you limit and ultimately eliminate the ability to produce. Now, from an investor's viewpoint, this offers up a very, very tempting target. While the big thinkers suggest that peak oil demand will occur sometime like 2030, some are saying it's already taken place. My own belief is that peak oil demand takes place in about 2045. And then there's a 30 or 40-year tail, which is to say that suggestions by the legislature that investing in oil results in stranded assets, my response would be to, as an example, Prime Minister Trudeau or President Biden, yes, but not in your lifetime. My suspicion is that these periods of underinvestment will allow people who invest in companies that are maintaining production to enjoy fat profits indeed, and not merely for 2023, but rather for a very long time to follow. Adrian, these big thinkers don't seem to pay attention to the fact that a billion people on Earth have no access to electricity. 2 billion people experience intermittent energy or energy policy. It should come, pardon me?
I said that includes Puerto Rico.
It should not come as a surprise to the big thinkers that 3 billion people around the world aspire to a lifestyle similar to the lifestyle that they live. And I would suggest to you that they have the same rights to it that the big thinkers do. Any suspicion that an energy source or a feedstock source that's as efficient as oil and gas is going to be phased out as a consequence of the good wishes of the big thinkers, I think is sadly naive.
Yeah, and part of the problem, of course, is that these what you call the big thinkers, they have
These are the extraterrestrials, just to clarify, right?
Yeah, they have this desire to stop oil and gas, but somehow they think they can turn oil and gas use off at a particular date, 2030, it all just stops. And they have these plans or schemes or deadlines before we have the replacement. So you can't cut off oil and gas before the replacement is, as it were, up and running, which it clearly isn't. You can't feed the world, power the world right now on solar and wind, however much people might like to. But
Adrian,
let me follow up with that, if I may. And sorry, Rich, you mentioned something that's a different topic, but you said you can't stop something as efficient as oil and gas. So can you expound on that, the efficiency of oil and gas?
Well, certainly the energy efficiency and the transportability of oil and gas relative to almost any other energy source in the world, with the exception of nuclear, which I think we'll talk about in a while, is such that it's very, very difficult to compete against. The big thinkers should take into account that society for the last 30 years has invested $4.6 trillion in various forms of alternative energy. Fair bit of money from my point of view, $4.6 trillion. And they've reduced the market share of fossil fuels in the global energy mix from 82% to 81%. So it's taken 30 years and $4.6 trillion to cost fossil fuels 1% in market share. Ironically, if the big thinkers were to encourage liquefied natural gas and back out the burning of coal to generate electricity, they could do more for air quality without any expenditure at all than they have done with the expenditure of $4.6 trillion in 30 years.
Yeah.
Well, my big issue is how are they possibly going to take their jets and their gas guzzling SUVs to the slopes in Davos to discuss these things if they cut off the supply of, oil? I don't understand how that's going to happen.
That's a wonderful thought. Them first.
Yeah, what's good for me, do what I say, not what I do, right? I understand from a few people out there that audio is a bit shaky. I'm not really sure what to do about that. Everybody sounds good to me here. I don't know if it's one-off or if it's a widespread thing. I'm not really sure how to fix that. We're just gonna push on through. There is one question on the subject. Aiden came in and said natural gas inventory seems to be surging across the world while price is crashing. Do you see this supply glut to last, or is this a golden opportunity to back the truck and buy gas producers?
I think it's a statement that markets work. If you look at natural gas prices today relative to natural gas prices 4 years ago, they're very, very, very high. Markets are messy, Rich.
Yeah.
But they work better than anything else. The cure for high prices is always high prices, and the cure for low prices is always low prices. So it really is a function of the listener's time frame and whereabouts he or she is looking to invest. We have a circumstance now where through a variety of factors, including limited takeaway capacity, there are some parts of the United States and some parts of Canada that are experiencing transmission failures, which is to say line pack. If you produce gas and you can't sell it, you're willing to sell it very, very cheaply. And we have circumstances like that. The European gas price has fallen too, but it's fallen from heights that were absolutely stratospheric, which is to say the price now has fallen to the point where it's only 6 times as high as it was 4 years ago. To me, this doesn't feel like a bear market. This feels like a bull market. The speculator that needs immediate gratification, which is to say he or she needs momentum in gas prices above the gas price, which is necessary to give producing companies net present values in excess of their share price, I can't help that person.
All right, fair enough. If I could, there's a follow-on question, if that's all right.
Please, please.
Obviously, we've touched a nerve here with energy. Let me see. And by the way, it seems like Troy might be an isolated incident with the audio. Everybody else around the world, Belgium and elsewhere, are telling me it looks fine right now. So what are your thoughts on energy royalty companies given the scenario, such as CICIO royalties and freehold royalties, and how they relate as investment compared to producers and pipelines? And what are the highest quality energy royalty companies in North America?
The oil royalty businesses are superior businesses in the sense that they don't have sustaining capital requirements. They don't have front-end capital requirements, and they don't have operating costs. In effect, their gross is their net, which is a good business. Yeah. Ironically, in periods where oil prices rise, the increase in margins for the royalty companies on a percentage basis is the lowest, which is to say, ironically, in a bull market, the high-cost producers enjoy better margin expansion and often enjoy better share price escalation. Rich, I'm at the age now where you can take away some of my upside if you take away most of my downside. So the consequence of that is that I'm attracted to the royalty business, although I understand that I'm limiting my upside in a crisis. There is a good argument that can be made that tourist investors, people who don't focus on the resource space, could make their entire natural resource portfolio royalty related, taking away some of the upside torque, but eliminating the operational and financial downside, and do well. The North American royalty companies have done relatively well over the last 2 years, although they haven't done as well as the gas-centric producers. But I would suggest in the next 5 years and 10 years that there's lots and lots and lots of room left. Importantly too, Rich, and the questioner probably didn't mean for this part to be answered, but that's okay. Given the fact that there's a dearth of funding in the energy business, given the fact that the big thinkers want to deny both debt and equity to the oil and gas business, there is an increasing opportunity for oil and gas producers to raise the quasi-equity that they need to do development through the sale of royalties to royalty companies. In other words, far from being static businesses, far from being declining or depleting businesses, these companies, as a consequence of their solvency, of their high free cash flow, and as an inadvertent consequence of the big thinkers restricting capital in the oil and gas business, have a wonderful opportunity to expand their royalty base by providing much needed capital to an industry that consumes it continually.
Gotcha.
Do you have some favorite names in that space, Rick?
I'd prefer not to, in the sense that this video will be viewed 2 years from now.
We hope so anyway.
I've learned that ruefully. I mean, certainly the well-known names, the sort of Black Rocks, the Prairie Skies, the PHXs, which are diversifying out of the royalty business, are attractive. For people listening to this, who I assume are not professional oil and gas investors, I would stick to the biggest of the best names. You know, you don't need to come down market cap when the beta in an industry for a decade is going to be as good as it is in oil and gas. You don't need to chase alpha. So go for the biggest, go for the best names.
Yeah.
As a follow-on on this topic, before we switch gears, do you ever see a point, given the impact and the efficiency of, you know, oil and gas, do you ever see a point where the green energy sources fill the void that would be left by oil and gas?
I think it depends on how fast how fast we adopt nuclear. Electric vehicles can be efficient. It's really a function of the grid. Can you get the power from where it's generated to where it's needed?
Good point.
And it's a function of the power. So certainly, to the extent that the big thinkers wanted to eliminate oil as a motor fuel, they could cause it to occur over 30 years by increasing the size of the nuclear fleet and spending a couple $1 trillion on the grid. I don't think that most of the big thinkers who are anti-oil are particularly pro-nuclear, but that technology is out there and it gets better every year and will improve faster as deployment increases.
Gotcha. That's actually, unless you have something to add there, Adrian, that's probably a pretty good point to segue here, because I think we're going to go nuclear at this point. Specifically, I want to talk a little bit about uranium. And again, I know this is near and dear to your heart, and there are booms and busts and resource cycles. I get all that, but talk specifically about the price of uranium and that relative to its cost of production, and where are we now?
Great question. Bit of a nuanced answer. I'm sorry. I know you like simple ones, but there isn't one. It is estimated that the incentive price for a pound of uranium from an existing mine, if you lump all of the production in the world together, which is to say the good, the bad, and the ugly, approaches $60 a pound. That's not the same as the AISC, the all-in sustaining cost. The cost I'm talking about is one that includes the cost of capital, because capital has a cost. It includes G&A, and importantly, it includes unsuccessful efforts, prior year write-downs, which is to say the total cost that the industry runs to produce a pound of uranium today, including the investment necessary to generate that pound and the cost of capital to do it, is about $60 a pound. The industry right now then is producing uranium for about $60 a pound and selling it, at least on the spot market, for about $50 a pound, losing $10 a pound. And by the way,
make that up in volume, Rick.
Yeah, that's right. Doing it 135 million times a year. Now, that isn't to say that all uranium is uneconomic. I'm talking about the market as a whole, all the pounds that are produced. It turns out, however, that the incentive price for new production, that is to bring new production online, not existing production, as a consequence of increasing social rents and inflation in the construction chain and the value chain, is more like $75 a pound. Now, this is interesting because we're already consuming substantially more uranium than we're producing. There's a void. When that void is used up, we will be able to make up about 40 million pounds through the restart of mines that have been shut down, but we'll still be 35 or 40 million pounds short, assuming that no new reactors get built in the next 10 years, which is not going to happen. So when we talk about the incentive price, there's really two incentive prices. There's $60 a pound for existing shut-in, hot shut reactors, or $75 a pound for new starts. Obviously, I'm extremely excited about this. The second thing that's happened, and I get to take a little bit of credit for that, is post-Fukushima, of course, we were producing for a few years an awful lot more uranium than we were consuming. And we built up an enormous stockpile. And we added to that stockpile, mercifully, by down blending weapons grade uranium, by taking warheads that the United States owned and the Russians owned, and turning them into feedstock, which I think was a very good thing to do. The price of uranium fell from what, $155 a pound, all the way down to $8 a pound. Two things happened. We cut back production, but the second thing that happened is that my former employer, Sprott Inc., through the Sprott Physical Uranium Trust, bought 55 million pounds of uranium. 55 million pounds of supply went to supply heaven. So at the point in time when existing above ground inventories appear to be tight, my suspicion is that the upside in both the spot and the term market will surprise people to the upside.
Interesting. Obviously, nuclear is an incredibly clean form of energy. It's incredibly efficient. It's incredibly powerful. It's a huge tool that we're not tapping into. Do you think that's going to change? Do you think we'll have a turn of perception like we did in Japan?
I think we're having that change in perception right now. You mentioned Japan. 3 years ago, public polls showed that in excess of 70% of Japanese citizens were opposed to nuclear power. Now the same polls show that 62% are in favor. That's a pretty amazing sea change. There is a real swell of popular opinion that suggests, irrespective of people's belief around global warming, that we should have less particulate pollution. It's kind of hard to argue with less particulate pollution. And the way you have less particulate pollution and still have affordable baseload energy is nuclear power. That's your only choice. It's interesting to note that the co-founder of Greenpeace is now a solidly pro-nuclear advocate, and he's a solidly pro-nuclear advocate for environmental reasons. He doesn't want to pump more junk into the water or into the air, but he understands that the 3 billion people in the world who experience energy poverty would prefer not to. And he himself doesn't see any reason why he should live better than they do. The consequence of that is that the co-founder of Greenpeace is a rabid nuclear advocate.
Interesting. So we are seeing the sea change. Anything to add to that, Adrian?
No, I mean, I think a couple of things just quickly. Yeah, I mean, there's no question to me that uranium has to be the centerpiece of any energy solution. If you look at coal, if you look at oil and gas, and then you look at uranium, those are the sources of energy that are the most efficient, in terms of energy in and energy out. And if you look at things like wind and solar and so on, they tend to be very, very inefficient. And in fact, with offshore windmills, if you look from birth to cradle to grave, as they say, there's an argument that in fact you're not producing any net energy. You're consuming the energy and building the things and then replacing them in X number of years. So there's no question in my mind that energy uranium is both extremely efficient, it's clean, it's also relatively inexpensive, and the good capital costs are high, of course. But the great thing about uranium is once you've built a nuclear power plant, the cost of uranium, A, you have to have the uranium, and B, the cost of uranium becomes sort of almost insignificant. You're going to buy the uranium to keep your nuclear plant going, whether it's $9 or $150 or $300. My concern in the near term, and you touched on this, Rick, my concern in the near term is that the move we've seen recently has been provoked by what I would call artificial shortages of supply, Cameco, Kazakhstan, and to some extent, artificial sources of demand, which you also mentioned, Sprott. And so, you know, Sprott can keep on doing what they're doing, which is great. But at some point, Kazakhstan is going to boost to full production, and Cameco is going to boost to full production. So I'm just concerned that in the near term, we are limited on the upside. And we're going to see this continue back and forwards, you know, in some of the uranium products like UU.
I agree with some of what you've said. The circumstance that we have now where demand substantially exceeds supply is partially a function of voluntary shutdowns by both Kazatomprom and Cameco. Both companies have said, we'll see what they do, both companies have said that they won't restart that production until they have enough of it contracted in the long-term term rather than spot market, that their shareholders can earn a reasonable economic rate of return on supply. For the last 10 years, consumers have relied on the spot market because the spot market has been oversupplied. It's been cheaper for them to acquire just-in-time uranium. We are entering now a period of time where a lot of the world's nuclear fleet is beginning a fueling or refueling cycle. And my suspicion is that partially as a consequence of Sprott taking 55 million pounds out of the market, that there isn't sufficient fuel in the spot market or even in the near term market that companies can sign 5 or 6 year spot-based term contracts. I think what you're going to see is, as a consequence of tightness in the spot market, increasingly economic term market conditions. I think as a consequence of that any resumption of production by either Kazatomprom and or Cameco will occur in the context of production into a market that is a contract or term market, not weighing on the spot market. I think the wild card really is the pace of Japanese restarts. I've thought that for a very long time. People look at small modular reactors as something that's going to increase demand, and it is 10 years from now or 15 years from now. The restart of the Japanese fleet does two things. It takes most of the remaining spot inventories out of the market. The remaining uranium held by Japan Inc. At the same time, it increases annually the amount of uranium consumed in generating nuclear power by between 12 and 15 million pounds a year. So it does two things. It reduces supply that the market currently believes is held for sale because there's no way for it to be consumed, while at the same time it returns 12 or 15 million pounds of consumption into the market. Longer term, the market is reasonably assured given the pace in particular of Chinese construction. I'm not talking about the 150 reactors that China says they're going to build on the Never Never plan. I'm talking about the 47 nuclear plants that are permitted, financed, and under construction today in China.
Right. Is China stockpiling any uranium, do you know?
I do not know. I'm probably as close as somebody like me could be to China General Nuclear. And the more probing the questions I ask, the more elliptical the response.
I mean, it would be, I've heard nothing about it, but it would seem strange indeed if China, you know, China Inc., which is accumulating all sorts of resources, were not accumulating the uranium that we know they're going to need.
Seems like their MO, yeah.
What China General Nuclear has done is that they have provided both equity and debt for uranium projects around the world, but in particular in Kazakhstan.
Right.
The Chinese have looked at productive capacity on their border, which is to say Mongolia and Kazakhstan, and also production in Niger and Namibia, and taken fairly aggressive steps to control production. Certainly, the production costs for Namibian production for China General Nuclear exceed the price they're receiving for the fuel. So you could say in effect, but that by operating uneconomic production, China is in fact warehousing fuel.
Right, right.
Good question from Aiden. He says, if Chemico has been signing contracts at 50 pounds or $50 per pound, but the price is expected to be much higher, why would they be doing such things?
Because they're market-related contracts. The near-year contract has a floor of 50, but a market-weighted upside. And the out-year contracts have both market-related and inflation-related escalators.
Gotcha. Okay. One other question. I want to shift. I want to get our hands a little dirtier here. The question is, how would the use of nuclear weapons affect sentiment? I think we could probably all surmise what that might do.
Those are the risks. I mean, the risks for the uranium story are threefold. A real global synchronized recession that would lower demand for electricity and lower the ability to finance nuclear power. A nuclear accident like Chernobyl or 3 Mile Island, or heaven forbid, Hiroshima or Nagasaki.
Yeah.
Anything that played on the public fear around nuclear could derail the story. Anybody who invests in uranium has to do it with the knowledge that if we had another major accident at a nuclear plant, that it would set the industry back 10 or 15 years and cut the stocks in half.
It's a real risk you have to take into account, no question. And obviously that has an impact on your horizon.
Now, most of the accidents, Rick, as you know, correct me if I'm wrong, have been at older generation plants or badly maintained plants or plants in earthquake zones.
I think that's exactly correct. And the truth is that every form of energy has substantial risks. I've been around the oil and gas business all my life, and we kill way too many folks. Today, in the oil and gas business, the risks around coal are well known. There are risks, sadly, in all forms of energy production. And if you look at the fatalities in the nuclear business, this is a very cold-hearted way to look at it. But if you look at kilowatt hours generated per fatality, nuclear power is probably the safest source of power on the planet. I realize that we'll get some hate mail for that, rather arithmetic response, but it has the disadvantage of being true.
Yeah.
Well, the analogy, Rick, I like to use to people is a bit like, transport fatalities. When an airplane goes down and 350 people are killed, it's headlines. But when 350 people are killed one at a time on roads, the only people who know about it are, the family of the bereaved family. But air travel, as we know, despite the headlines, is far, far safer than traveling by road per mile traveled.
Agreed. Absolutely agreed.
Yeah, yeah. Rich, do you have another question there?
I was going to switch again, getting our hands dirty, because I was doing a little digging, getting ready for this. I'm a gold guy. I'm not an energy guy. So I wanted to prepare, and I want to get to coal because I know Rick's been talking a lot about coal, and that wasn't on the agenda. I've got another question on nuclear. It's kind of long. I'm going to kind of paraphrase here. Where do you put the nuclear waste? How do you get rid of it? The U.S. has no permanent storage facility for nuclear waste. South Carolina has become an unfortunate dumping ground, waste stored in cylinders that last 50 years and a tremendous cost to taxpayers. And who wants this in their backyard? Clean? Nuclear is the most toxic form of energy. Unless you count the cost of containing the waste forever, you're not accounting for all the costs or the risks. Get a comment?
Yeah, sure. If I had my druthers, I guess we would build an above ground nuclear waste storage facility on Capitol Hill.
That is very useful and efficient.
That would be my first choice.
I'm with you there.
The second thing is when you talk to nuclear engineers in particular, and you talk to them about the waste problem, they say the first thing is make sure we can get it back. Because as technology improves, we're going to need that stuff. So what's important to know about nuclear waste is that if you utilize 1 million pounds of uranium for fuel, you extract the first time through about 4% of the energy. And then you send that 1,000,000 pounds of fuel back for reprocessing. And you use it again. And then you use it again. Rich, if your entire life's energy consumption had been nuclear, the amount of terminal waste that you would generate would fit into an 8-ounce orange juice can. Now, you would have to store that well. It isn't just that nuclear waste has radioactive toxicity. It also has molecular toxicity, so that you have to store it well. The fact that we don't have any permanent storage facility in the United States is certainly not the fault of the nuclear industry. You can store nuclear waste efficiently in a wide variety of terrains. It is useful to have Proterozoic or Precambrian Archean rock, very dense rock. It's useful to have that in a dry place. You want it to be very, very, very stable. Mercifully, the world probably has, I don't know, 20 million hectares that fit that description. Aurora, Nevada fits it very well. The northern part of the Canadian Shield fits it very well. Western Australia fits it very, very well. Western Siberia fits it well. You don't want water invading the storage facility. You don't want to expose yourself to an earthquake. You want to store the waste well, but you want to store it in a way that you can get it back. When people talk about radiation, well-intentioned people like your questioner, one of the things that they need to understand is that one coal fly ash field in the Monongahela in eastern Ohio generates more background radiation every year than every nuclear facility in the United States. A major hospital that has a lot of radiology produces more escaped background radiation than a nuclear power plant does. There's a lot of misinformation around nuclear power. I'm not trying to suggest that if things go wrong, that they don't go really wrong. And certainly I continue to believe that the biggest risk around nuclear is, of course, Parliament, the legislature, people who occasionally banty around the idea that to further their policy aims, they ought to chuck a nuclear weapon at somebody.
Gotcha. So let's make that diversion now to coal. And again, it's just because it struck me as I was doing a little background work here. You talk about coal, and you would think coal was dead, that we don't even mine any coal anymore, given the current climate. But that's not the case. Can you give us some numbers about the recent consumption?
Well, interestingly, the second largest year for coal consumption on record was 2021, eclipsed by the largest year for global coal consumption on record, which was 2022.
And why is that?
Well, because coal is an extremely efficient source of electricity. Again, a billion people in the world have no access to electricity whatsoever, and they're poor people, and they want it. When countries like China and India and Brazil and Indonesia and Pakistan go to a climate conference, they remind, sometimes politely, the big thinkers that carbon consumption needs to be measured on a per capita basis. So while it's true that India is a big carbon producer, it's a big carbon producer because they have 1.3 billion people. If you measure their consumption on a per capita basis, they're small consumers. They also mention, much to the consternation of Al Gore, that carbon loadings are cumulative and compounding. So if you're looking to blame somebody for carbon, you have to look to blame societies that have been burning carbon for a very long time, say Germany, Britain, and the United States. The consequence of that is that countries that need low-priced electricity are building coal plants like mad, irrespective of whatever pledges they make to keep the folks at Davos happy. I think, Rich, you're relatively close to Baltimore.
Yeah.
Port of Baltimore, aren't you?
Yeah, we're near DC, so we're kind of in that triangle.
Yeah, so, mercifully for the Port of Baltimore, Germany decided 5 or 6 years ago to phase out conventional energy and rely on wind and solar, ironically, in a place where the sun doesn't shine. The consequence of that, of course, is that now, in a cold German winter, with the Russians shutting them off, the Germans are buying every scrap of coal that the US will produce, including coal that has such high ash and such high sulfur that we can't burn it in the United States. You wouldn't dare burn this stuff in a cold place like West Virginia. But in a green place like Germany, they'll take all they can get. It turns out that people are somewhat less green when the lights go off.
Yeah, understood.
By the way, I'm not defending coal.
No, you're just stating the facts, I think.
I am a coal investor because it was very clear to me during the COVID and Greta hysterics that the world wasn't going to stop burning coal. And when the coal price was at half the cost of production, it seemed to me like the world had two choices: increase the price of coal or get very cold. And I thought it was lucky that the price of coal would increase. The price of coal doesn't need to go up anymore. The price of coal is extremely generous, and people in the coal industry are making money beyond their wildest dreams. So this isn't a situation where the coal price has to go up, but it is also not a situation where demand for coal is going to fall anytime soon.
Gotcha. All right, Adrian, I think you got
Yeah, I'd like to get this question in because I think it's a very important question.
Yeah.
It should be our last question, but I just don't want us to miss it. An anonymous attendee asks, why are commodity cycles so brutal in their final stages? How can you prepare for them as an investor, as a young man, if you've never experienced anything like this?
The latter part of the question, how can you prepare as a young man when you've never experienced anything like it, is that you can't. I myself went from being a very, very, very wealthy young man in my 20s in the commodity business to having a net worth that was sub-zero when the 1970s commodity bull market fell apart. But that taught me an important thing. It taught me that markets work. And if you come to understand that the cure for high prices is high prices and that the cure for low prices is low prices, but that there is a lag before such time as markets are allowed to work, you begin to understand something about the commodity cycle. It is true, Adrian, absolutely. And I hope the questioner is listening, that in resource markets, if you are not a contrarian, you are gonna be a victim. That's what's gonna happen to you. On the buy side, you look for a commodity that's priced below the global cost of production, where the use for that commodity is necessary to maintain the standard of living that humankind has. When the oil price fell during COVID to $20 a barrel, it was very clear that it required $60 a barrel to make oil. So either the price of oil was going to go up or your car wasn't going to start. That's how you do the bull side. The bear side seems to be that when an industry as a whole is enjoying 50% plus operating margins, by the way, the coal business is, and I think the oil business might be now, you need to begin to be cautious. I feel okay about the oil industry simply because they aren't reinvesting the surplus cash and they can't raise new cash. They're deferring sustaining capital investments. So ironically, because of the legislature, which hates oil, oil would seem to continue to be a good investment. But in answer to the question, when everybody and their brother is talking about a commodity, and when it seems like it couldn't possibly get any better, it won't. It'll get worse. Human nature is that people don't believe a thesis until the price action has confirmed it. And often by the time that the price action has confirmed it, enough of the move is gone that it's no longer a good investment. That's just the way people are. Nobody seems to want to own oil when it's at 20 bucks and it has to go up. And everybody seems to want to own it at 120 bucks when it likely has to go down. That's human nature.
Yeah.
People need to have common sense overwhelm human nature, which is a very tough thing to do.
Yeah, I think your experience of losing money early on is a nice thing. It happened to me as well. You know, if you can earn your get your lessons and lose your money when you're young and poor, that's much better than doing it when you're older and a little wealthier. I mean, I think you've given some good thoughts there, Rick. And to me, I think the first thing people have to understand, and I say this to all our prospective clients, you have to understand that resources are incredibly cyclical and volatile, both on a long-term basis and a short-term basis. You know, the stocks that you and I buy can go down 5% in a day and we don't even think about it. Right. You know, the Dow goes down 1% and it's headlines. You know, these stocks, but also they're cyclical on a long-term basis. Again, you only have to think what happened from 2011 to end of 2015, when the major gold stocks lost what, 86%? That's 86% for the big stocks. We're not talking the little ones. So the first thing you have to do, I think, is just really appreciate just how volatile these things are. And there's reasons for it that perhaps we don't have time to go into. There's reasons why commodities tend to be more volatile than, you know, retail products and retail services. But we don't have time to get into that. But there's a follow-on from that, which is, okay, if we appreciate that resources are volatile and resource stocks are volatile, you know, what do we do about it? And what's your view? Someone asks here, what's your view on using stop losses on volatile resource stocks?
I think that stop losses have some use in large cap liquid stocks. I think in very small cap stocks that stop losses are only good to maintain the track record of newsletter writers. These things are so volatile and so thin. Remember that a stop loss triggers a market order. And if there's enough stop loss orders in a penny stock, there can be a circumstance where there's almost no bid. It is also unfortunately true, Adrian, as you know, that although sharpshooting, the process by which market makers take a stock down to trigger stop losses, although that's illegal, it happens every 5 minutes, every trading day. So utilizing stop losses on an Exxon or a Chevron or a BHP or a Rio, maybe all the way down to, say, an Alamos, you know, down to a sort of $1 billion market cap, makes some sense. Using stop losses in penny dreadfuls is, I think, suicide.
The problem, of course, Rick, is that even the large cap resource stocks, I'm not talking Exxon now or BHP, but even the large cap resource stocks are tiny compared with Apple and Microsoft.
Of course. And
I just pulled up a chart of Franco-Nevada here. You know, I can see in the last 6 months, 1, 2, 3 places where any reasonable stop loss would have taken you out, and it would have taken you out at 120 or 112 or 130, and the stock's now 150. So my own view is that stop losses simply don't work in volatile resource stocks, you know, under the Exxon and Chevron. I prefer to think of stop losses as protect profits. So if you have a stock that's gone up a lot, you can protect your profits if you're willing to lose the stock. But if you're not willing to lose it, you know, I think you're going to get taken out. And then the question, of course, is when do you buy it back?
Do you just accept additional risk and just deal with that through position sizing? I'm guessing you're going to have risk in the sector, and if you're okay with that, then you buy the stock. If not, look for a different sector.
That's certainly what I would say. Perhaps it's due to my own lack of skill with stop losses. I need to say, Adrian, say it's the wrong phrase. I need to admit that, as with other forms of hedging, my track record with stop losses is almost unblemished by success. So for me, you know, I try and know enough about a company that if it falls by 25% in price, rather than sell, I'm a buyer. I, in my own mind, have a feeling for what a company is likely to be worth in various circumstances, and what it's likely to become worth in 2 or 3 years. And my buy list is predicated on that sort of thing. So for me, if I was happy owning Franco at 130 and I saw it at 112, it's very unlikely that I would be selling any of my stock irrespective of basis. It's much more likely that I would be a buyer. Now, that's hurt me from time to time because every now and then you're flat wrong. The market's right. But I think that I would rather go into the exercise with a sense of what I thought a stock was worth and buy it when it felt too cheap and sell it when it got too dear, and not worry too much about trading techniques as much as I worried about understanding valuations.
Good point.
Now, Adrian, I know you've got a few other questions, and I do want to get there. I want to at some point get to both of your thoughts on gold, silver, precious metals in general. But there's a good question here that I think is worthwhile, and I think because of how you two approach the market, you may answer this differently. I'm not sure. Basically, it was from Deanna. She says, Rick, can you please explain how you go about assessing commodity stock? I think that would be a good question for Adrian as well, but it may be very different because of the roles you play as a speculator versus a manager.
I think Adrian and I will answer that very similarly, frankly.
Really? Okay,
But
good.
I'll go first. I try to figure out what something is worth. I don't care too much about market momentum. I try to do what's called a net present value analysis. I use publicly available documentation to try and estimate as best I can what the future cash flows of a company's proved developed resources will be, and discount that back using current commodity prices in the future strip. Then I add back resources and even sometimes some upside potential, if I think the upside potential is very well documented, after subtracting the capital costs that would be necessary to bring that stuff in production, as discussed in existing publicly available, sources. Against that, I subtract sustaining capital, debt, all that kind of stuff to get what I consider to be a net present value. Then I run that net present value at lower commodity price assumptions to get a down case, and I run it at higher commodity prices to get myself an up case. And I use this matrix of pricing to determine a range of what I think the company could and would be worth in a variety of circumstances. And if I have a circumstance where the enterprise value of the company, which is to say the market capitalization plus redundant cash minus debt, is substantially below what I think the company is worth now, or what I think the company will absolutely certainly be worth 3 to 4 years from now, I'm a buyer. That really is what I do. Now, it's important that anybody who sets out on a quest to establish value understand that they're never, ever, ever going to get it right. The idea is to get it right with a range. The idea is to understand that you're competing against people whose valuation methodology has got a hunch, bet a bunch. And you don't have to outcompete the world. You just have to outcompete most of the world. And that's less of a challenge than it might seem.
Gotcha. Adrian?
Yeah, 3 points if I may. One thing, clearly you have to distinguish between whether you're investing in a company but you're going to hold for a few years, or whether you're speculating on some drill hole play. And obviously the analysis you're talking about talks about, investing in companies. And I think, let me just emphasize something you said, which is about running your model at lower commodity prices. And that's critical. And people sometimes wonder, they say to me, Newmont, Barrick, most of the big gold companies are doing their resource estimates of between $1,100 and $1,200 an ounce. I had someone just recently say, don't they know it's 1800 now? Well, yes, but the problem with the resource business is it's a very, very long-term business. You know, from the time you start looking for something, to discover it, to build it, to produce it, and then eventually, you know, it's up and running as a mature mine, depending on whether it's a gold mine, a copper mine, where it is, and so on. I mean, that can be 10, 20, 30 years. So when you're a company deciding whether to build a new project, you don't want to look at the latest price forecasts from, brokerage firms, let alone newsletter analysts. You want to do a downside case because this is a cyclical business.
Right.
I'll just add a couple of things to what you said, if I may. One thing when I'm looking at companies that's very important is the track record. And the second thing, and the most important thing of all for me, is people. People to me are critical to businesses, whether it's Apple or Nestle, but even more critical the smaller the company is. And as I mentioned earlier, most of the resource companies are pretty small in the context of the S&P and the Dow Jones companies. So I don't invest in any, certainly gold or silver company. I don't invest in any gold or silver company before I get to know the management. And the management can make a huge difference, a huge difference. I mean, whether it's Richard Atkinson at Freeport, or whether it's Mark Bristow, for example, would be a perfect case where one man has made a huge difference to a company, Barrick. Now, that, of course, has a downside. If a company is dependent on one person, we don't need to say what that downside is, but it's obvious. But to me, people are absolutely critical. And then the lower you get down the food chain, the more people become more important.
I agree with everything you said, Adrian. I was trying to answer a valuation question. And in terms of getting to a buy-side decision, what you say is absolutely correct. It isn't just the asset, it's who's operating the asset. You couldn't be more right.
Good point.
And I don't know who it was who said it. Could have been me, I don't know, but it may have been Andre Gamond or Pierre Lassonde, I can't, or Robert Freeland, but you know, a good person, he'll take a good person with no money and a lousy property over a good property with money and lousy management. Because the lousy management will find a way to spend the money and screw up the property.
You know, it's funny you say that, Adrian, and we're going to drift a little bit from investment to speculation. But I've been spending more time recently analyzing the arcanery of various proxies, in particular with small stocks, the change of control agreements and the severance agreements. There was a transaction 3 or 4 weeks ago, a $6 million transaction, where the departing managers and directors got 1.8 of $6 million.
Yeah.
There is another circumstance on the Toronto Stock Exchange where there is a company where the officers and directors collectively control about 1% of the stock, and they have 5 years severance agreements.
Yeah.
So
No,
what you say about, you know, first of all, a bad person is unlikely to build a good company, but a bad person that gets control of a good company will often find a way to steal it.
absolutely. Yeah. Yeah.
All right. There's a few questions here along the same lines, and I think it's a good time to bring it up. One says, which commodities are currently priced at below cost of production other than uranium? And others were like, which commodity is likely to go up most in the next 3 months? So we're all kind of leading toward the same thing. What do you see as the best performing commodities going forward? What should people be looking at now?
The next 3
segue
months,
after that to gold, because
next 3 months, I don't have any opinion on at all.
the future. Let's just
That
say
isn't the way I think.
Yeah.
I am investing. I'll talk about my speculations later.
All right.
I am certainly investing and speculating in the uranium side. I'm, to help you with the segue, investing in the gold side because I really see the wind in gold sails. I'm
We're going to get to that in a second about contrarianism and whatnot, but go ahead.
Yeah, well, I don't think it's contrarian. I mean, the gold price and the gold shares are up nicely in the last 3 or 4 months.
Clearly. Yeah.
So there's a lot of tourists in the trade, but I think it has further to go. I'm still investing in the oil business, but I'm only investing in companies that are making sustaining capital investments, which many are not. Many are paying out delicious dividends. I mean, absolutely delightful dividends, but they're cannibalizing themselves by way of doing it. I believe that the copper business will be a very good business, but I think that anybody who invests in copper, or zinc for that matter, or nickel for that matter, all commodities I like, need to take into account that any sort of recession, we've gone a long time without a recession, will postpone the inevitable in those. They need to be thinking in the 5 to 6 year time frame. If you're going to go in those base metals, you can't be thinking in the 1 to 2 year time frame right now. But I really believe that if somebody has a long enough time frame, which most people don't, that the whole commodity complex is going to do reasonably well. We have underinvested as a society in commodities for a very, very, very long time. Adrian and I joke at the investment conferences that we go to that the world's copper mines are beginning to look like us, which is to say decidedly over the hill. Bingham Canyon, 155 years old. Chuquicamata, 110 years old. Escondida, 45 years old. Grasberg, 50 years old. It's not like Adrian and I can stand at the edge of the pit and throw in water and fertilizer and have them grow more copper. We're really, truly running out of copper. But if we have a worldwide recession and you lower demand, you can lower supply and still not raise price. So people have to be conversant with all of that. Where I am becoming increasingly bullish, and Adrian may disagree with me on this, is that we're in a risk-off phase. And the market isn't paying as much attention to exploration, even successful explorations, as it ought to. And for people who have the expertise, who are willing to do the work, and have both the psychological and the financial staying power to be in the business, I think we're going to come back into a junior exploration cycle. The money that was raised 10 years ago for exploration got put to work, and it takes about 10 years to make a district begin to work. And I see deposits around the world that are starting to work. And I see investors ignoring them because the stocks are going sideways as opposed to up.
That was the money spent in 01 to 2011.
Yeah, I mean, it's been spent, it got raised in the sort of 2006 to 2011 timeframe.
Okay.
It's been spent. Some of the companies managed to eke out some more raises, some more capital raises 3 years ago, spend some more money. But I'm seeing these deposits develop, and I'm seeing nobody really care. And when I look at the size that some of these deposits will likely go to, what the net present value of those deposits will likely be, and what the majors will have to pay to get control of 5 million ounce equivalent deposits, it looks pretty attractive to me.
No, I agree completely, Rick. And, I've had this discussion with 1 or 2 companies. We can talk about it next week when we meet, but, there's the old saying, and you've used it many times, cry when they're buying and sell when they're yelling. And
Yep.
I say to people, what are people, where's the hot demand right now? Sure isn't in exploration. So you need to be putting more money into exploration where the returns are not immediate, but the exploration business generally is I think the most undervalued sector of this market, no question.
If you could afford the risk, both psychologically and financially.
Yes, absolutely. And also it takes more knowledge. You have to do, you can buy Newmont or Barrick, let's say Newmont, Barrick and McNego, and you can buy Franco and Royal Gold, and you may not know much about all of them, and you may get yourself wrong on one of them, but you're going to do fine. But you can buy 5 exploration companies and you can absolutely destroy your capital if you haven't done the homework.
Right.
Yeah.
All right, so a couple questions now about precious metals, so maybe we should switch there. I know we're all fans, and I think we generally look at them the same way. But one question, we talked about this, everybody, it's all over the internet. You can't open up your email without getting hit with 5 emails about gold is going to the moon. So I know where that's coming from. We probably wrote some of those. Then also there's the thought that it's a managed, the precious metals are managed or manipulated, whatever word you want to use. So how can you fight against the Fed, the government, City Hall, whatever? So what are your thoughts on this climate going forward for gold, silver, platinum, palladium, any of the precious metals? What do you like? What don't you like right now?
For most people, I like gold. I'm long gold. And as you say, I'm philosophically disposed to be a gold bug. But I look at several factors. The first is that for most of my career, the real determinant in gold doing well was the difference between the real yield and the nominal yield, U.S. Treasuries. Gold faced headwinds for 40 years because the U.S. dollar was strong and interest rates were low and inflation was low. That party, I think, has come to a screeching halt.
We don't have that problem right now, do we?
Right. Let's look at the arithmetic around the U.S. 10-year Treasury, which I would argue is gold's biggest competitor. The U.S. government promises to pay you what, 350 basis points, something like that, 3.5, in a currency that the Congressional Budget Office, not some cranky old libertarian, says is running 7 or 7.2. So the government solemnly swears to demolish 3.5% of your purchasing power a year, compounded for 10 years. A promise, by the way, I believe they'll keep. Jim Grant calls that return-free risk. Now, let's look at that and let's consider another fact. The biggest institutional investors in the world have been trained over the last 40 years to have at least 60% of their portfolios in bonds, mostly long bonds.
Yeah.
And the bonds have treated them well. There haven't been defaults. The interest yield has been good. They haven't had to mark them to market. And if they have, they marked them up. Been a wonderful thing. But that party's come to a screeching halt too. We saw in the London gilt market what happens when the capitalized value of distributions goes down and when you hold a long asset financed by short money. It turns into an absolute disaster. Now, Rich, think of yourself as the manager of a very large endowment, maybe the Stanford University endowment. And don't tell me I quit. Hear me through. You got a $30 billion endowment, and you got to look after the institution and the kids who are just being born who want to call it a Stanford education, all that kind of stuff, 20 years from now.
I know where you're going with this, and I like the numbers, by the way. So.
And you got a bunch of 30-year bonds in there. Now, a couple lousy things have happened to you. In the last 2 years, the rate of interest on the 30-year bond has gone up substantially, pardon me. So the capitalized value of the bond has gone down, which is to say your $30 billion portfolio, if you marked it to market, didn't go up, it went down. Mm-hmm. A different problem is that the yield that you get on the 30-year bond, by historical standards, is lousy, but the real yield you get in a 30-year bond is negative. So the obligations that you're going to have to your institution 20 years from now, 25 years from now, you aren't going to be able to match. You aren't going to be able to meet. There is going to have to be disintermediation, which is a fancy way of saying asset switching out of long bonds and into other assets. I'm not suggesting that 60% of institutional portfolios worldwide are going to exit bonds and buy gold. That's not going to happen. What I am going to say is that some of the money that comes out of the bonds, that has to come out of the bonds, will likely go into an asset that has a millennium's worth of track record fighting the debasement of the currency. And here's the crowning one, Rich. In the U.S. market, the market share for precious metals and precious metals related securities is less than 0.5% of total savings and investment assets in the country.
Those are the numbers I love. It doesn't take much, does it?
The 3-decade mean is 2%. Gold doesn't have to win the war against the US dollar or the US Treasury. It just has to lose less badly. If the market share of precious metals reverted to the 40-year mean, demand for precious metals would quadruple. Now, what could go wrong with that thesis? Well, Congress could balance the budget.
Okay, I'm holding my breath. Next.
So, I feel good about the gold price. If you feel good about the gold price, you have to feel good about the gold producers. Because the gold producers, if you look at net present value relative to enterprise value, they're selling at the best prices. Well, they're not selling as well as they were 3 months ago, but on balance, they're selling at the best prices that they've sold at for 20 or 30 years. And if you look farther down the quality trail into the juniors, caveat, out of 2,000 juniors, there's probably only 200 that are viable. But if you look all the way down to the best of the juniors, I would suggest they're cheap. If the gold price does well, the senior gold stocks do well. And if the senior gold stocks do well, it probably sets off a bull market in the juniors. And I'm not suggesting, Rich, by the way, that if you like this narrative, that you put 100% of your net worth in gold. That's stupid.
Agreed.
Most investors have less than half of 1% in gold. It would not hurt my feelings to see them at 5 or 6.
100% agree. What about you, Adrian? Similar?
Yeah, no, I agree completely. And obviously the thing about monetary metals, gold being the primary monetary metal, the analysis of demand is completely different from the analysis that you do, with base metals or other things.
I agree.
And the supply, frankly, because there's so much above ground supply. I'm not suggesting for a second that the central banks are going to turn sellers or all the vaults are going to be emptied. But the analysis of supply and demand is different for a monetary metal than it is for a physical metal. And no, I think Rick has answered it, exactly.
Yeah, we've been advocating do what the central banks are doing right now. They're actually buying gold, right? They've been doing that, and they stepped up their gold buying over the past couple of years. So I think you take that as the example you want to follow right now. And I agree, you don't want to go all in. We've got clients, we try to talk them out of it, and they're saying I got 50% of my assets in gold. And we're like, that's crazy. That's too much. What is the number? I think it's 8 to 12% or something like that is the sweet spot. We go at 10 because the math's easy. I mean, and some people call that high, but certainly more than 1.5 to 2%. I would give you for gold, and it's insurance the way we see it. Silver, I think I know where you guys stand, probably pretty close to what we do. That's where, if you're going to look at precious metals, that's where I think you can make money. I've got a lot of people asking about platinum, palladium. Their fundamentals are very clear. They're more industrial than monetary for sure. But the influence of Russia and South Africa on those markets and be able to predict, those price swings, it's too hard for me to do. I like silver. Silver is a bit more basic, and it's you get spillover from gold when gold is running, and it tends to outpace it. And for profit, I like when something outpaces something else.
Right. I think I should just mention, when you say 10% and, whether it's 5 or 10%, we're talking about physical as an insurance.
Yeah. And I remember
that on top of, I wouldn't say my entire gold exposure is 10%.
100% agree.
On top of that, of the stocks that you buy for investments or speculations.
I used to get a lot of calls 25 years ago, new members to an investment newsletter or whatever, where they said 10%, in gold. And they're like, okay. I said, what do you have? They go, well, I got 5% in gold. I'm like, well, what are you holding? And I'm thinking Credit Suisse bars, Gold Eagles. They're like, no, I got 5% of Newmont Mining. I'm like, you don't own any gold. You own 0 gold. All right. Now, that doesn't mean you shouldn't own Newmont Mining. It's a different allocation that comes out of your equities allocation. And I'm not a money manager, but gold for insurance is physical gold, something nobody manages in my book.
Right. I agree with that.
Rick?
How could you disagree? I'm in the odd position myself of, because of my large ownership in Sprott and other parts of my portfolio. A rational financial planner would probably tell me I don't need to own any gold. But I don't consult rational financial planners, first of all. I own a fair bit of gold, and I do it because it helps me sleep nights. I regard my physical gold ownership as insurance. And I'm in the odd position of owning a fair bit and actually hoping the price goes down, because the set of circumstances that would cause the price to go up would alter my lifestyle. And my lifestyle is fantastic. I don't want any alteration. But part of my lifestyle is the fact that I'm old enough and I've been lucky enough that I'm pretty solvent. And part of my own solvency is in gold. And I would wish for any of my friends to have the same financial peace of mind that I do.
Good point.
Right.
Yeah, so somebody said, well, why does Rick like gold more than silver? Wouldn't all precious metals do well in a negative real yield environment? But I think
I think you own gold and silver for different reasons.
yeah, exactly.
Silver is the poor man's gold. It's more volatile. Everybody likes upside volatility. And for some reason, nobody seems to like downside volatility. My experience has been that when you have a precious metals bull market, that the momentum has to be established by the fear buyer. It has to be established by gold. After the momentum has been established, after the narrative becomes adopted, the poor man's gold, silver, moves further and moves faster. There's room in portfolio, including my own for silver, but it's not insurance. You own it for other reasons. Certainly, all of us have experienced the fact that the most volatile asset class in precious metals is silver equities. There isn't enough market capitalization in the silver space to handle the generalist investor money that comes in when the narrative changes, which is an absolutely delightful thing. But you might have to wait 5 or 6 years for it to occur. And I don't think that people should wait 5 or 6 years to own the insurance part of their portfolio. They can wait 5 or 6 years to own the speculative part of their portfolio, because if they miss it, who cares? But it's just, they're different asset classes.
Right. And you mentioned something about silver equities that's important, or to me, it's important for people to understand. You know, it's simply a much smaller market cap than even gold equities. And your choices, I mean, if I want to buy a gold stock, you know, there's a lot of good quality gold companies, large royalties, small royalties, big cap miners, exploration. There's a lot of good quality. You go to silver, and the truth is there are very few good quality silver companies out there. And an awful lot of the companies that people think of as silver miners, dirty little secret, are not really silver miners at all. Pan American Silver, Fortuna Silver, you know, they get what, 20 to 30%, sometimes 40% of their revenue from silver. A lot of it
comes very inelastic, right? You're mining something else typically for silver.
Yeah, a lot of their revenue comes from lead and zinc. So, but because they keep silver in the name, those will be go-to names when silver, and I'm not knocking them, I own both of them, by the way. I'm not knocking them at all. But they will be go-to names when the silver price moves.
Gotcha.
It's funny you mentioned that, Adrian. A shameless plug for my upcoming silver boot camp on February 11th.
We're going to get to that. Good point.
When we were looking for silver companies to invite as sponsors, one of the criterion for everything like that I do is that I have to own them. When I searched through my managed accounts and my own accounts, I found out that out of the whole universe of silver companies, I could only send out 9 invitations. What you say about a fairly small number, and by the way, the 9 invitations included companies that didn't have a majority of their revenue from silver. You can guess what they were, Adrian.
Right.
There really truly is a limited universe of even silver pretenders.
Yeah.
So
and one of the reasons for that, of course, is that there, as you know, there are very few primary silver mines.
Right.
You know, if you go back 40 years, something like 70% of the world's silver came from primary mines.
Right.
Today, the numbers are totally reversed. It's something like 25% of silver comes from primary silver mines. Some of it comes from gold, silver mines, so that's okay. We'll give that a pass. But an awful lot of it is byproduct from lead and zinc.
So just so you know, we're about an hour, 20 minutes at that point,
Okay.
at this point. And I knew when we had thousands of people sign up for this webinar that there was no way on God's earth that we were going to get to every question. I hope we did a good job and a satisfactory job for everybody to get to as many as we could. At this point, I think it's probably time to do a little bit of a recap. And then I want to talk about the follow-up. There were some questions about, will we get a copy of this? And for those who want to hear it, yes, we're going to send out a link to the full webinar tomorrow to everybody that registered. So whether you attended or not, you're going to get a copy of it, along with a few key things that I'll touch on when I go. But I just want to go around the horn and kind of ask this question. And then if there's anything you want to shout out about, please do. The question is, looking forward in 2023, because we talked, we know what happened in 2022. We just lived through it. But looking at 2023, where do you see the best opportunities in your world? What are you focused on most right now?
I'm doing exactly the opposite of what the market's doing. I'm beginning to come down the quality trail. I went to higher quality companies 5 or 6 years ago for the most part. The market and resources is concentrating among the biggest and the best. I'm not selling them, but I've liquidated what is for me a fairly large real estate portfolio a couple of years ago, and I'm redeploying some of the assets farther down, sometimes substantially farther down the quality trail. In a separate part of my life, I'm celebrating retirement. I'm about to turn 70 by starting a new bank, Battle Bank. And so the most important additional investment that I'll make in 2023 is providing more capital to my own bank, which means, I guess you could say, well, I think this is true. I'm shifting my bond portfolio too, which has been a substantial part of my portfolio over time, to bonds of my own construction. When I look at the covenants on bonds that I see coming out of Wall Street and Bay Street, I'm not impressed with them as lenders. So increasingly, the debt instruments that I own, I want to be of my own construction.
Gotcha. So yes, Battle Bank. How can people find out more about Battle Bank?
Battlebank.com.
Okay.
Battlebank.com. Particularly if you are a Checkan physical precious metals owner, we look forward to offering loans secured by physical precious metals in segregated storage.
Yes, we've been looking for good people to do that properly for many years. So.
I'm delighted that my competitors in the banking business don't seem to think that gold is good collateral.
I can't think of better. So just so everybody knows, Rick mentioned the Silver Boot Camp. When is that going to be exactly, the dates? It's
Silver
close.
February 11th. I think we forwarded you a link, which perhaps you can forward to the people.
Yeah.
Those of you, I'm sure people on this call attended the Uranium Boot Camp. Like the Uranium Boot Camp, this is between 8 and 8.5 hours. We will have the Silver Institute give you the same sort of overview of the silver business that WMC Nuclear did, the nuclear business. We will have living legends that will talk about how they built multi-billion-dollar silver companies and how the lessons that they learned building those companies made them better investors and can make you a better investor. We'll have top-ranked silver geologists that will talk about the geology of silver. We will have analysts and portfolio managers who've been in the silver business for years and years and years, not people who 5 years ago couldn't spell silver. Importantly, you will be able to replay the symposium tape for 6 months. I've now replayed the uranium tape 4 times, despite the fact that I caused it to occur. And probably most important of all, tuition is only $99 US. And if you're not 100% happy with the product, I will refund your tuition. An absolute, no questions asked, money back guarantee. If we didn't teach you what we promised you, we don't want to charge you.
Good stuff. And that's been the case with you always. One more thing I want you to mention, there's something going on in Boca Raton in July that's going to bring us all together, not through Zoom, but in person. All three of us will be there. What's that all about?
I think this may be my 30th Natural Resource Investment Conference. I don't know, because I'm 70 and the mind fades over time. But for many years, we've put on a Natural Resources Investment Symposium in Vancouver, British Columbia. As a consequence of COVID, I didn't have the courage to do it in Canada last year, knowing that with our customers, there would be border incidents with the ArriveCan app going into Canada. And so we temporarily relocated to Boca Raton, Florida. We relocated to the Boca Resort on 245 acres in Boca Raton with a half a mile of Atlantic Ocean waterfront, a resort that Michael Dell now has $1 billion in. Suffice it to say, it is very nice. A room that in the winter would cost you $1,100 a night is yours at our conference for $290. This is a conference that stood the test of time. Adrian has spoken at it since inception. We'll have a wonderful array of great speakers. We will have exhibitors that either, if they're service providers, we have never had a complaint about, or we will have issuers that are owned in my own portfolio or in portfolios that I manage, which is to say, sadly, not every stock I buy goes up, but there is a guarantee that the exhibitors have been vetted. And once again, a 100% money back guarantee. If you attend the conference and you aren't happy with the result, yes, we will have wasted some time, but the tuition's on me.
I have to really give a big endorsement for that conference. It is without question an absolute must for anyone interested in resources, not because of a wonderful hotel and the cheap room rates and the wonderful beachfront that you mentioned, but because of the quality of the presentations and the speakers. And, you know, Rick manages to pull in, we know how he does it, but he manages to pull in many of the legends, people like Robert Friedland and the people from Franco have been there in the past, and you know, these people hang around. They're hanging around. You can go and talk to them. It's just a wonderful, wonderful conference, I have to say.
Thank you very much, Adrian. I do want to say I had an attendee 4 years ago email me and said, Rick, I stalked Robert Friedland around the exhibit hall. Watching what booth Robert Friedland went to and listening to the questions that he asked was worth the cost of admission all by itself.
There you go.
And what you say is true. Watching the living legends, people who have built multi-billion-dollar mining companies, talking to them one-on-one or coming on our boat cruise, frankly, and having a glass of bourbon with them, having the gurus of the world, the Adrian Days, the Jim Rickards, the Jim Grants, not just hit and run, but stay and participate in the conference, attend other people's workshops. It's tough to beat a circumstance like that.
Yeah, 100%.
So the links for both the Silver Boot Camp and for Boca Raton will be in the follow-up email that goes out tomorrow with the link with this full webinar. Just Todd says he can't make it to February 11th, but could he pay to get a recording? I assume the answer is yes. And yes. I don't know if you're hiring, but Tiffany wants to work at Battle Bank. Now, Adrian, what are your thoughts? What do you see as the thing you want to focus on going forward this coming year?
2023?
Yeah.
You know, I'll just stand back from resources for a second, if I may, and just look at the broad market for just 1 second. I think the risk in the broad market, and not just the US, but major developed markets, is extraordinarily high. And to me, everything in investing is about risk reward. You know, I might buy something with a high risk, but an even greater reward. Right now, the risk reward in the broad market, I think, is extraordinarily high. I mean, first of all, bear markets do not end at 18 times earnings. I don't know that that's ever happened in history. Secondly, right now, I mean, this is astonishing. This is astonishing. The earnings per share for the S&P, $223.65 per share. Analyst consensus estimates are $223.01. The analysts think earnings in the next 12 months are going to be down less than, I can't even do the math, less than 1/10 of 1%. if we have a recession, that is cloud cuckoo land. So you've got a market that is trading as though earnings are not going to go down at all, and is trading at 18 times earnings, which is not high compared with, 4 years ago, or it's not high compared with Tesla, but on a historical basis, that is way above the average multiple of the market. And you could look at price to book and so on. So I think the risk in the broad market, let's just say earnings decline by 20%. Let's just say 10%. Earnings decline by 10% in a recession, which is nonsense. And let's just say that the price earnings multiple contracts, because when earnings go down, typically the price earnings multiple contracts. Let's just say the price earnings goes back to 16, which will be the highest pre-2016. So I'm being extremely conservative. You're looking at a 25% decline in the market if those two things happen, and those are cautious. So I just think it's time to be very, very cautious about the broad market. And, we're buying very, very little at the moment. We're doing some trades in the market when things get just way oversold. And the problem with that is you can be too early. We're selling puts on things, which right now in this kind of market is extraordinarily profitable. 2 weeks ago, I sold some puts. This is just, if the SEC is listening, it's nothing to do with blah, 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 whatever disclaimer it is, past performance and all that good stuff. But just an example of what puts can give you. Intel, which is a good quality company, got absolutely crushed. We were selling puts with 4 to 6 weeks left on them, and we were selling them at a strike price that was 10% under the 15-year low price, and we were getting 6%. You just can't beat that. Puts are extraordinarily profitable right now because the market is volatile, that increases the put premiums, and because people want protection. People who own these stocks want protection. So the price of buying puts goes up, therefore what you can get for selling puts goes up. Anyway, so I'd be very careful about that. And basically the only thing we're buying, for investing right now is really resources.
Gotcha. And that's actually a good point. So from my standpoint, and by the way, Adrian, we'll have a link in there. Anybody looking forward to signing up, getting more information about Adrian Day's asset management. He's incredible when it comes to both global and resource stocks. Certainly if you don't have the time to do it yourself, one of the first people I would look to would be someone like Adrian. And I know we have over the years. From my standpoint, I'm with you. I've been saying for a year now that in this environment, where basically the cost of everything you own is falling in value, while the price of everything you need is going up in value. If you're looking where to make money, you got to be investing in things that people need, because people are going to shift. If they haven't already, they're going to shift from wants to needs. They have to in this environment. So there is a question about agriculture and things of this nature. We didn't talk about it, but agriculture, energy, commodities, these are all important things that I think your money is worthwhile. Another important thing is information. A lot of people are walking away from their subscriptions and things of this nature because everything got rocked last year. What do I need you for? And they're turning into do-it-yourselfers. I can lose my money just as fast as anyone else can. But I think that's a mistake. I think now you need information more than ever, personally, my gut feeling. And I know I sold it, but I'm a firm believer in gold and silver right here. I do think that, I don't get wrapped up in short-term movements. I know it pulls back, it goes up, it pulls back, and everybody says that's the end of the rally, and I'm disappointed in gold. Last year, so many people came to me and said, Rich, why isn't gold doing its job? I'm like, are you kidding me? It's absolutely doing its job. It was flat last year when the dollar ended the year up 10% after being up nearly 20, and it was flat. And it was the only precious metal that wasn't positive last year, while the NASDAQ lost a third of its value. Bitcoin lost 2/3 of its value. The S&P lost 1/5 of its value, and the Dow lost almost 1/10 of its value. And bonds, worst market in history. So yeah, gold did its job. In a deflationary environment, it loses much slower than everything else, and it's about holding on to what's yours, not making money in that environment. So I'm a firm believer in gold. In order to get people to act on that, our offer through this webinar is anybody who buys $5,000 worth of precious metals from us from this webinar will go ahead, we'll do free shipping, handling, and insurance, and a free Silver Eagle with every order. So, and that'll all be laid out in the thing yesterday or tomorrow. The only other thing I want to say is I'm just truly blessed to have a co-host like Adrian Day. My God, thank you, Adrian, for saying yes a few quarters ago. I'm so happy to have you on board, and we're so blessed to have friends like Rick to bring that knowledge and share it with all these wonderful people that we're blessed to have listen to us and shop with us and come to our seminars and do these things. So just thankful for where we are. I think 2023 is going to be wonderful. I'm not the sky's falling guy. And if you want it to be so, make it so. So thank you, gentlemen. And thank you all.
Thank you.
All right. Last thing I'll say, we don't have a date yet, but we're looking forward to our next quarterly webinar. Another name you might have heard, Doug Casey has committed to join us. We just got to pin him down to a date. So
I'll sign up for that one.
Looking forward to that one as well. So thank you all and have a wonderful evening. Thank you for participating.
Thank you, everyone.
Bye-bye.
Bye.